Welcome back to Business on City News 570, powered by Cowan Insurance. We are joined by a first-time participant from Cowan Insurance Group, Gregory, Aodhan Johnson, and he, of course, is an investment advisor at Cowan Financial and Worldsource Financial Management. And we haven't had him on, so let's take it easy on him because he's, we don't want to scare him off. He's very smart about on the investment side of things, and so we want to welcome you to the show, Aodhan. We will take it easy on you today.
Yeah, good to have you here.
Yeah, perfect. Thanks so much, guys.
Listen, Greg.
Look, this is a really interesting subject that I think when people learn a little bit more about it, like we have in dialogue just before we went on air, I think it opens up a whole world of opportunities for individuals. So we want to talk about the First Home Savings Plan that is now available. So why don't you give us kind of an outline as to what that actually is?
Yeah, of course. So the First Home Savings Account, it's a federal savings plan in Canada, not just Ontario, but all through Canada, designed to assist first-time home buyers in saving up to $40,000 on a tax-free basis. It has similar attributes to other registered plans like an RRSP or a TFSA in ways any contributions to the First Home Savings Account are tax deductible, which is really great if you're looking to minimize your taxes. And any withdrawals similar to a TFSA are actually tax-free. So it's kind of like the best of both worlds.
Yeah.
A few things to notice though for being eligible for this: you do need to be a Canadian resident at least between the ages of 18 to 71, as that account would max out at age 71. You do need a valid SIN number, and it has to be your first home or your first lived-in home in the last 4 years.
So explain that. So explain that part. So I've already bought my first home. I'm still in. Well, I guess I'm in my third home, but I'm living in a home. I couldn't. If I sold this place and started renting, I could start saving, and after 4 years, if I wanted to then re-enter the home market, but I've been renting or doing, but not owning a home, I would be eligible for the program. But it really is geared towards those that for that first-time homeowner to help them accelerate saving, because we know there's a big downstroke on just about any home now, and so that first $40,000, it accelerates your ability to save that. Have I got that about right?
Exactly. That's perfectly said, and it's a great reason to look at why the government brought that in. It's because, as you just said, in the last year alone, homes have risen. I believe it's up to 16% since January of this year in Ontario, and so it's a 2% month-over-month increase on homes since May 2023. And with increases like that, original plans like the First Home Buyers Plan through your RRSP only limits people to $35,000 that needs to be paid back within 15 years. A benefit of this FHSA, it doesn't need to be paid back. And each person, if you have a spouse, if you're in a partnership, you can both hold an account in your name, save up to $40,000 over a span of 15 years, tax-free withdrawals on a registered first home purchase. But there's also a lot of other costs that people don't know that come into play when buying a home. And so you can actually use these funds on closing fees, legal costs, moving fees, et cetera. So, and anything that isn't used can be transferred to an RRSP or a TFSA.
You know what's really important about this is today's day and age where it's so difficult for young folks to get into a home, and they're turning to their parents in a lot of ways and saying, how can you help, or can you help? This would be a way you could help. As a parent, you could, help your kids get started with one of these plans, give them maybe a little bit of money every year to contribute towards that plan. The individual gets a tax receipt for the contribution in the year in which they make it, and then when they pull the money out, they don't pay any tax on it. Like that is exactly like having a blended TFSA and an RSP. I think it's absolutely perfect. And it should be encouraging a lot of people to set these programs up so that they can, maybe get their first home, but additionally having parents help out along the way too.
Yeah, of course. I'm glad you said that, because even parents, grandparents, although it doesn't offer immediate tax benefits to the parent or grandparent, it is a great way for intergenerational wealth transfers, to, as you said, gifting funds to that child or grandchild to put towards that.
Exactly.
Last quick question, because this has been fascinating. I hope people have been paying attention to it. Obviously, go to our friends at Cowan if you have questions, and Aodhan Johnson is there to answer your questions. For many for us at the chamber, how we help our employees with retirement is we have matching programs where things like we'll match up to 5% of the salary for RRSPs or TFSAs or an RESP, education saving plan. Is this another one of those ones that would be eligible, because it's a registered product? If someone was making those, so you can accelerate it with either, as you say, grandparents or family members, but also an employer matching program would be eligible for this type of program as well.
That's a great question, Ian. I'm not too sure on the eligibility for it to be matched. I do know it's a registered account like a TFSA or an RSP. So I wouldn't be surprised if at some point in the future, if not already, some companies are taking initiatives to set that up, if not matchable, at least to recognize it and push employees to look at it.
All right, perfect. It's been fascinating. We've been joined by our good friend Aodhan Johnson. He's an investment advisor at Cowan Financial and Worldsource Financial Management.